You are listening to The Vocal Technologist. Spoken tech for your ears.
I swear, the only thing moving faster than the crypto market structure we are about to get into.
Is the sheer amount of coffee you needed to get through this week's material.
Exactly. I mean, we have a mountain of analysis here, and it's all screaming one thing. The game has completely changed.
It absolutely has.
Yeah.
And that's really the mission today, isn't it? We're trying to look past the day-to-day price swings and really understand the seismic shifts happening underneath. In the tech, in regulation, even in these internal governance fights.
Yeah, if you want a shortcut to getting smart on the new era of digital finance, this is it. Our focus is pretty clear.
Right.
We want to pinpoint exactly where that easy money kind of gold rush era of crypto ended.
And where the institutional infrastructure-focused era really begins.
Which means we have to dig into these governance wars, the stablecoin revolution, and that high-stakes scaling race. We're getting into the core mechanics that are going to define the future.
And for anyone who follows our analysis, maybe on The Vocal Technologist,
yeah,
we're always looking for those inflection points. This isn't just an inflection point. It's a total structural reformation.
Okay, let's jump right into that. That idea you have about the golden age ending, I find that analogy really compelling.
Yeah, I think the golden age of easy crypto profits, it's a bit like online poker after 2003. It's definitively over.
So you mean the days where you could just, mint a quick NFT collection and expect a 10x?
That's it. That whole era is finished. The idea that you could hop on some new DeFi protocol and get a huge airdrop, that's just not the reality anymore.
The bar for success has been raised then, dramatically.
It has. Simple strategies just don't work now. Success demands real discipline. A work ethic, you have to read the white papers, stress test the protocols, develop an actual thesis.
The market got efficient?
It got efficient, and it demands expertise.
Which sounds tough for the average retail user, but I'd argue it's necessary, right? For the long-term health of the whole ecosystem. It kind of cleans out the pure speculation.
And that's the key difference from something like poker, which is, it's a zero-sum game.
Right.
Crypto isn't. We're still expecting to see this inevitable tenfold growth in adoption because the tech value is real. And, crucially, we're finally getting constructive regulation. The long-term outlook is still incredibly bright. You have to earn it now.
And nothing reinforces that shift to accountability quite like regulatory enforcement. I mean, we have to talk about the fallout from the Terra collapse. That alone felt like the end of the free-for-all.
It's the definitive sign. Market maturity means personal accountability. The people behind these systems, they're going to face real consequences for fraud.
Case in point, Do Kwon getting a 15-year prison sentence. The judge explicitly called out the, quote, eye-popping magnitude of a $50 billion crime.
50 billion.
It's just...
It's an unbelievable number.
And Kwon's despicable conduct, specifically telling retail investors to keep buying while insiders were quietly cashing out, that sets a huge precedent.
It clarifies exactly where the line is. If you mislead investors and commit fraud at that scale, the blockchain isn't some magic shield from the law.
But it's not all about punishment, which I think is an important point. We're also seeing clarity for the systems that do play by the rules. Like the SEC formally closing its 4-year investigation into the Aave Protocol.
That is critical context. I mean, a come-up is a massive DeFi protocol, right? We're talking billions of dollars. The fact that the SEC did a 4-year deep dive and came up with nothing.
And then formally closed the case.
Right. It adds a FOV to this growing list of cleared firms. This is market maturation in action. Fraud gets punished, but genuine compliant protocols get the green light to keep building.
So if regulation is starting to solve the fraud problem, the engineers are racing to solve the performance problems. Let's shift from legal structure to technical structure, because the scaling wars, I mean, they show exactly where users are voting with their feet.
It really is a numbers game now, and you have to be, numerically literate to see where things are headed.
Absolutely. And when you talk user dominance, the numbers just demand. We talk about Solana's growth.
It's explosive.
We saw its total value locked, its TVL surge from, less than 1% to almost 9.5% of the entire market since 2023.
And the transaction numbers are even crazier.
82% of all blockchain transactions since January 2023. And it doubled Ethereum's DX aggregation volume.
So while Ethereum is still, the most valuable platform for complex financial apps, Solana was just leading the charge on raw user count and daily transactions.
Hmm.
It's winning the throughput race.
And that lead is about to get a serious upgrade. We have to
Right.
talk about Firedancer hitting the Solana mainnet. This has been talked about for years. What's the practical shift here?
Okay, so think of Solana as this high-performance race car that's been running on one really optimized engine. Firedancer from Jump Crypto is like a completely new parallel engine. It's written in C, it's got this modular architecture, and it basically eliminates that single point of failure risk that caused outages in the past.
So a huge boost to network reliability.
It is, but the performance,
Yeah.
that's the real game changer in testing on just regular commodity hardware.
Not some exotic supercomputer.
No, standard servers.
Yeah.
It demonstrated over 1 million transactions per second. 1 million. That pushes Solana right toward its ultimate performance goals.
That kind of speed is phenomenal, but doesn't chasing that massive TPS introduce centralization risks? I mean, compared to Ethereum's security-first focus on layer 2s?
That is the core trade-off, and Ethereum is tackling a totally different problem, state growth.
Right, the
Yeah.
blockchain getting too bloated.
Exactly. As the network gets older, the amount of data a full node has to store, the state, is getting huge. It makes it more expensive and harder for people to run nodes, which,
Yeah.
that risks centralization.
So Ethereum is trying to clean up its fundamental structure. What are the fixes they're proposing for this storage problem?
They're looking at a few things. You can think of it like cleaning out the attic. There's state expiry, which is like throwing out old inactive data.
Okay.
There's state archive, which separates the hot data you use all the time from the cold data you rarely need.
Yeah.
And then there's partial statelessness, where nodes only have to hold the little bits of data they actually care about.
So two totally different philosophies. Solana is pure layer 1 speed, and Ethereum is focused on structural integrity while pushing speed to its layer 2s.
And those L2s are getting faster. I mean, we're seeing throughput go from 30,000 to over 100,000 TPS already.
Right. And all this engineering matters because when it fails, real money gets lost. Which brings us to that massive $653 million liquidation cascade.
653 million. And it wasn't a hack. It was just faulty internal logic.
It was the technical cost of market stability, but relying on, what, an obsolete mechanism?
Exactly. The loss was blamed on this old algorithm used by exchanges like Hyperliquid and Binance. It's a greedy heuristic from back in 2015.
What does greedy heuristic actually mean here?
Think of it like a faulty fire sprinkler system. A small fire breaks out, and instead of just spraying that one spot, this thing soaks the entire building.
So it overreacts.
Massively. It targeted profitable whale market makers over and over in minutes, liquidating way more than was needed just to cover the bad debt. It overshot and created all this unnecessary loss.
Wow, so the very thing designed to keep the exchange solvent actually made the losses worse by being too aggressive.
Precisely, which is why there's all this new research into things like risk-aware pro rata mechanisms, which are way smarter about how losses are shared. It just shows that even the most basic parts of market plumbing need constant refinement.
That attention to internal mechanisms is the perfect transition to one of the most fascinating dramas right now, the Aave DAO versus Aave Labs battle.
Oh yeah, this isn't just a dispute. This is a stress test of the entire DAO model against the for-profit company that built the software.
So the whole thing started when Aave Labs made what seemed like a small change to their website, right? They swapped out one token swap service for another.
They replaced Paraswap with CowSwap.
Hmm.
But the crucial part is where the fees went, those swap fees. 15 to 25 basis points. They were redirected from the DAO's treasury into wallets controlled by Aave Labs.
And that adds up. We're talking an estimated $10 million a year.
Right, and Aave Labs' defense is basically, hey, the website is separate from the on-chain protocol. We built it so we can monetize it.
But the token holders are pushing back, saying Aave Labs has a fiduciary duty. They're arguing that the Aave brand itself, the thing that drives traffic, was paid for by the DAO.
True years of governance, risk-taking, treasury spending. The brand belongs to the DAO, not the labs.
And it escalated fast. I mean, it led to this radical proposal, a poison pill lawsuit?
A move straight out of the corporate raider playbook. It's really intense.
So what does this poison pill actually do?
The proposal is to sue to transfer all of Aave Labs' intellectual property, the trademarks, maybe even company equity, over to the DAO. It would essentially force the for-profit developer to become a subsidiary of the DAO.
Wow. That is a battle over the fundamental question, who owns the brand? The community that governs it or the private company that codes it?
It's the highest philosophical test for DAOs today. And even with this fight going on, Aave Labs is still pushing ahead with its 2026 roadmap, a V4, Horizon for real-world assets, a new consumer app.
Right. They're building for a bigger future while fighting over the present. And all of these internal battles are happening because the regulatory walls are finally coming down.
Which brings us to the biggest story. Stablecoins are becoming core financial infrastructure.
The separation between traditional finance and digital assets is just, it's crumbling, starting in the U.S. with the FDIC.
Yeah, the FDIC approved the rule to implement the Genius Act
Why is that so important for banks?
because it creates a clear official path. It lets FDIC-supervised banks issue their own payment stablecoins. It's the first time they've had a real regulatory blessing to get into this space.
But the rules are really strict, aren't they?
Oh, absolutely. They're designed to prevent another Terra. These stablecoins have to be 100% backed by the safest assets. Cash, short-term treasuries, insured deposits, minimal risk.
And at the same time, the Fed walked back its restrictive policy.
Exactly. The regulatory traffic light just turned from red to green across the board.
And when regulation provides that path, the infrastructure follows. We're seeing real-world integration, and Visa is the perfect example.
Visa is now using stablecoins to settle transactions on its U.S. network. Specifically, they're using Circle's USDC on Solana.
For banks like Cross River Bank.
Right. This is a huge shift. Stablecoins are no longer just a consumer product. They're the back-end plumbing that enables 24/7 near-instant settlement. It's an infrastructure revolution.
And it's not just partnerships. We saw JP Morgan put its own internal JPM coin onto Coinbase's base chain. Why would a private bank use a public chain?
They want the 247 programmability of a public ecosystem for things like collateral and margin payments. But, and this is key, they keep to controls. They use permissioning so only approved institutions can touch it.
The ultimate hybrid model.
It is. Leveraging public tech with private control.
Yeah.
And that model is global. Japan's SBI is launching a yen stablecoin. Even Bhutan launched a gold-backed token on Solana.
All of this convergence is changing who the major players even are. I mean, look at Coinbase. They're rolling out commission-free stocks, prediction markets, in-app Solana trading. They're starting to look a lot more like a neobank than a crypto exchange.
And their secret weapon is Coinbase Advisor. It's an AI that takes natural language, your financial goals, and turns it into an actionable plan using their product.
So they're building this all-in-one financial hub.
Exactly. Combining that AI with their own stablecoins and payments, it makes them a serious threat to traditional finance.
To wrap this up, let's go back to one of the most fascinating real-world examples of utility you found, the shadow exchange rate for stablecoins in India.
This is just raw technological efficiency solving a complex problem. There's this persistent 6% premium for USDT in India.
Which perfectly mirrors their tax on imported gold.
It's not a glitch, it's a feature. It functions as this unofficial shadow exchange rate. Smugglers are now using USDT, which they buy at that premium, to pay their gold suppliers overseas. It's basically a high-tech upgrade to the old Hawala system.
Wow. It's proof that the tech has real utility, even in the gray markets. So to pull this all together, the market's maturing, regulation is clarifying, and the fight has shifted. It's not if crypto exists anymore, it's who controls the plumbing.
And that presents an existential risk for the old guard. We know TradFi firms are embracing tokenization, but they're doing it on their own permission-controlled rails.
They're trying to adopt the tech without losing their moat, basically.
Precisely. So the final provocative question for you, the listener, is this. If these incumbent firms fail to compete with truly open, permissionless innovation, what happens next? Will they use a combination of adoption carrots and regulatory sticks to force everything toward permanently permissioned crypto-like systems? Will they neutralize the very innovation that makes this space so powerful, that struggle between open protocols and closed rails? That's the defining challenge to watch.
Spoken Tech for your ears.